Money Radio for a really great future. We're talking real money.
You know how old people always say, particularly, when they're really getting up there in years, they say things like, well, when I was young, I remember when such and so were doing this thing. Well, let me tell you, I remember the days when we charged big fat commissions to buy and sell stocks or mutual funds or pretty much any investment you wanted to get into. Heck, mutual funds could even cost you 8.5% of the money you put into the fund. You could pay $200 for a stock trade. Those were the good old days. Or were they? Now you can trade for nothing. Hi, welcome to Talking Real Money, the podcast. I am Don McDonald. That guy over there is Tom Cock. We think of ourselves as George Burns and Gracie Allen.
Don't ask which one.
See, another old person thing. Only old people will know who we're talking about.
Actually, in that case, really old people. But
really old people.
Yeah, sorry.
You're Gracie.
How come you get the cigar on this one? What's the heck, anyway?
Yeah, I'm either Groucho or Gracie, one or the other. Grouchy. Oh, I'm sorry, Grouchy. Grouchy. I misread
Groucho,
that.
too. That's a whole other shtick. We'll try that next time.
All right. So anyway, what are we talking about? Free commissions. They're everywhere. Does anybody pay a commission to buy or sell stocks or securities of any kind anymore? I can't remember the last time I paid a commission.
I don't even think the major brokerages charge their customers that anymore, right?
Wow. I don't know. I mean, you have a lot of the I think they still do. They probably do. I don't know that for a fact, but I'm pretty sure. But they did buy a lot of these discount, which have become free brokerage firms like E-Trade, which was, who bought that? Somebody bought that. Morgan Stanley or...
I don't remember who bought. Morgan Stanley bought E-Trade. That's correct. Yeah, that's right.
So you've got Schwab. Well, they own Ameritrade.
Yep.
You've got E-Trade, which is owned by Morgan Stanley. And then
but
you have
the big one.
Well, they're not the big, but they're getting all the big new business.
Yeah,
and that's
half of all new U.S. brokerage accounts between 2016 and 2021 opened at Robinhood. Wow. Then good for them. I mean, I guess. Although I hate the fact that they promote gambling. I hate the fact that they promote all these wacky quote unquote investments, which are not.
What is it that happened that enabled the industry to go from very expensive to absolutely free?
Yeah, and the numbers, you just can't even believe it, because according to the Wall Street Journal, the average daily share volume off and on U.S. exchanges is somewhere around 17 billion.
17 billion trades?
Trades is what it says. Average share volume. Share volume.
Wow.
So that compares, by the way, to prior to COVID, about 7. So whatever the measure, I'm not sure I know exactly what they mean by share volume. If that's the dollar amount, it might be.
No, it can't be. That's too little in dollars. It has to be the number of shares. Yeah, it does. Average share volume, number of shares.
Which is just insane. 3 times as much in 6 years. That's a lot. And as you pointed out,
was that on the New York Stock Exchange or all the exchanges?
It says all on and off U.S. exchanges. So all exchanges. This is everybody. And this is a trading revolution, right? I mean, this is free. Really got to go back to Schwab, the ones that started this revolution. But if you ask people at the time, there's one quote in this article that says, "Not everyone's going to survive this," predicted one expert cited by the Wall Street Journal back in 2019. They didn't just survive, by the way. Schwab stock is up 150%. As you mentioned, Morgan Stanley snapped up, et cetera, et cetera. But what is, there's a couple of things to think about, I think, here that are important if you own stocks, because things that you should not overlook. Number one, these places, they're still making money. What did you say? 8.5% for a trade? It used to be in the old days.
8.5% for 8.5% commissions on mutual funds, and it was on small trades. The commissions were very, very high.
That's just seems like insanity. That's hard to believe it was the same lifetime, but they're doing things like charging you for holding cash. they're collecting payment for order flow, right? Where they deliver those trades and what happens there, whether that's a conflict of interest. I'm still surprised that the SEC hasn't looked into that further with Robinhood. They kind of did for a little bit, and then it all kind of went away.
Well, we're in a period of no financial regulation to speak of.
Yeah,
we're in a very, very different political period than we've been in the past. Oh, by the way, what was your average daily trade number?
It says here 17 billion.
Billion. Okay, that's right. That is the number of shares traded globally.
Okay.
What was it? Let's
see.
see.
In 2019, it was about 7 billion.
Yeah,
so
and
the point is it's 3x.
Back when I was a broker, now we don't have the global numbers from back then, but the New York Stock Exchange, which is the largest still, or maybe NASDAQ is, but anyway, 109 million shares back then.
109 versus
million.
17 billion with a B.
Yeah. It's increased a lot.
I don't have my calculator to tell you what the X number after that 109 to 17 billion is, but it's a lot. It's pretty much an increase.
It sounds like about 100 times more.
Yeah, it's significant. But so there's an aspect of, kind of what's going on here, et cetera, et cetera. But I think what we want to talk to you about is what it means to you as an investor, right? We're always looking for that. Because
are you getting a deal? I think really is.
Yeah.
Are you getting a deal? And I think the answer is a qualified, yeah, you are. Because I think one of the reasons why it's working so well is because it's been a volume play. The volume of trades rose so rapidly that you could make less and still be profitable.
Make less on each trade?
On each trade.
Okay. I thought you meant the investor could make less and still be profitable.
That Schwab or Ameritrader, Robinhood, or whomever is making less than they would have made 20, 30 years ago, 40 years ago. But because there are so many more trades, the little bit that they make it goes farther.
Well, there's that. But also, as I said, they find other ways to charge you. If you're inefficient with things like cash, well, they find a way to use that money, even charge you for that money.
Schwab is really good at that.
Yeah, at being really smart about moving that around. But I'm more concerned, frankly, the fact that what this means to investors, because free trading to me, I hate to say it, but it's like free drugs. I mean, once you get going, the dopamine is there. They've proven this, right? Financial success, financial euphoria is basically the same as taking a hit of some major drug. And so all these people that have become traders, and we've talked about this on the program several times, this is right from the article. Studies show there is an inverse relationship between how often someone trades and their returns. Those foregone gains go somewhere, and it isn't money heaven. That's what I'm trying to get at here. That, again, it feels great, right? Because I'm not paying anymore. But is that true?
Yeah, you don't want to trade. And you're right. Robinhood, particularly, not only their pricing, but their entire attitude is to encourage trading because that's how they make money. They're getting less per transaction, but if you can create, again, back to my point, more transactions by getting people to trade more often, then that bid-ask spread, the difference between what you get when you sell stock and what somebody offers to pay when they're buying it, and this payment for order flow, those pennies here and there start to add up to real money after a while, and it costs you. However, as an investor, not a trader, you can use these low prices to your benefit.
Yeah, I'm really talking about traders here because what this indicates to me is there's just more trading in the market, more daily trading, more people moving money in and out, more feeling good about things or feeling depressed. And we also know, by the way, that Robinhood among them has promoted, riskier bets on things, more leverage, all kinds of it's really poorly designed exchange traded funds that people are excited about because it looks like I'm going to make a lot of money. I think they've also, Don, recreated something that you and I had thought had gone away in the Well, basically the late 90s, a thing called day trading. You remember day traders, the people that were sitting around?
Oh, my gosh.
moving?
You wouldn't believe the arguments I had with day traders, both on my show and in real life. I had a neighbor who sold his air conditioning business and decided he was going to become a multimillionaire day trading. And funny thing is for a few months or maybe even a couple of years, he did until he didn't. And what happens is with a day trader, it's like a gambling addiction. You don't cut your losses and stop. No, you keep doubling down.
Exactly. And by the way, day trading success, depending on who you ask, I think I went back and read a paper by Larry Swedroe. Somewhere between 1% and 3% of them are actually are beating the market, doing better than markets by being in and out and timing things and buying the right stocks and selling them, et cetera, et cetera. And that does not, by the way, include taxes, which is something to consider as well.
And the gambling metaphor is particularly apt when it comes to Robinhood. Because Robinhood, on a day-to-day basis, I think they have a room full of people sitting around going, okay, how can we get people to move money faster? And they've discovered amazing things like, for example, in the state of Florida, you can only sports bet through one source, and that's Hard Rock. They have an exclusive because of the Seminole tribe, and they have an exclusive deal with Florida. So it's illegal to use the Caesars or the FanDuel or any of those things. In many states, it's illegal to sports gamble at all. Robinhood found a way around it. You can sports bet on Robinhood by using derivative contracts in the prediction markets.
Yeah, prediction markets are just a horrible idea. Again, and this is one of my big problems with, frankly, now all of the custodians is when they make things like that available, people want to compare investing, which is putting your money and exposing it to stocks, companies, with, you just said it, prediction markets, sports betting, all these things. There is no comparison. Absolutely 110% no way.
But Robinhood still couches prediction market derivative purchases and sales as investing as opposed to pure and adulterated gambling. At least FanDuel says, we are a casino. If you have a gambling problem, here's how you get help. Robinhood doesn't have to say that. If you have an investing problem, here's how you get help.
Exactly. And frankly, if you're an investor, dopamine should not come into play in any way, because investing, as we have said, is like watching grass grow or paint dry. Mm-hmm. It's really not exciting, and that part of your brain really is not going to get all worked up about it, and that's the way it should be.
You need to find another source of dopamine. Now, I'm not going to suggest what that should be.
Wait, we're going to sell that on Sundays,
my
right?
own versions, but
I'll bet you do.
It's not gambling.
No.
Not drugs. It's not drinking. Anyway.
You get the message, I hope.
I don't know. I'm not that old.
You know, the messages we've been getting have been plentiful. A lot of them.
The questions?
Yeah, those.
Oh, good. I love
TalkingRealMoney.com. You can go there and ask us questions or talk to an advisor or do that stuff, and I love it.
What do you got?
I got a few. I think Raymond has written us before from Royalton, VT. Doggone it, that's Vermont, right?
Vermont,
VT?
yes, sir.
Okay.
Yeah.
I think I had the same question last time.
Virgin territory. It's the new territory we just got called the Virgin territory. Speaking of, do you know what the designation used to be for Hawaii? The abbreviation for Hawaii back in the 1940s.
I?
No, it was HT.
It was HT?
Hawaiian territory.
Oh, that makes sense. Okay.
I watched last night. I went to bed and decided I wanted to watch a little documentary, and I was looking through the documentaries, and I found this one on HBO, I believe. And it said December 7th, 1941. That was the name of the documentary.
Yeah. What'd you learn?
Well, I didn't learn a darn thing, except in 1941, the U.S. government was trying to stir up a great deal of hatred towards Japanese Americans, because this was filmed during World War II. I think it was made by John Ford, and they hired some actors, one to play Uncle Sam and one to play Uncle Sam's conscience. And It was mainly about, this is why you should hate Japanese people. They're all fifth column members.
This had to be 1942, not 1941. Because
it was filmed.
December 41.
The title was December 7th, 1941.
I see. Okay. Yeah.
And what they were doing was predicting in this fictionally thing the attack on Pearl Harbor and blaming it on all of the Japanese Americans living in Hawaii. But
if you want to ship somebody off to camps, you got to fire people up, right? I mean, that's the way it goes.
And it was, I saw it, I went, HT. What does that mean? Oh, Hawaiian territory, of course.
Didn't know. What, 58? What year did that become a state? Something like that, something in the late 50s, right?
60.
Oh, 1960.
59 or 60.
Okay.
Alaska, I think Alaska was 60 and Hawaii was 59. Pretty sure.
Okay. So, all right. You'll let us know about that, I'm sure. But here's the question from Raymond. And Raymond, thank you for listening and sending a lot of questions. What's a tokenized stock?
A tokenized stock?
Yeah. What does it mean to...
I don't know. What does that mean?
Tokenize a security. Yeah, you do. Turn it into a token for trading.
Oh, does this mean like blockchain?
Yeah, exactly. This is not new. This is out there.
Okay.
Some people think this is going to be the future of trading altogether, right?
I don't. I mean, maybe. I don't know. Who? Oh, gosh. Now I'm going to have to look this whole thing up.
No, we've talked about this briefly. We have. Because somebody else asked us about it a few months ago. Will this be the future? I think there's people now running around the country saying this is how you're going to be trading in the future when it comes to stocks, bonds, et cetera, ETFs.
Okay. Oh, yeah. You're not trading a real stock.
Correct.
You're trading a non-fungible token version of it.
Yeah. Bingo.
It's just a fake version of a stock. It follows the price of the stock, but it isn't the stock, and it's not a security. And why the heck would you buy it? They're fake. Again, like NFTs, like crypto, they're fake.
I don't think it's anything to worry about right now either, by the way, and I don't think you need to get out in front of it. You can still trade at your favorite your custodian right now, and you can, as we just mentioned, do it for free. So,
you know what it reminds me of? And I only know this because I've done some pieces on the history of investing. It reminds me of the bucket shops in the
that's a good call.
In the 19th century, early 20th century.
Yeah, right.
Bucket shops would get a ticker of the exchange, and people would just make bets
on the tape.
The bucket shop.
That's
on
right.
the tape. They would make bets on what these stocks would do. They weren't actually buying stocks. They were just betting among each other.
Correct.
On the price of stocks. Does that sound like investing to you?
No, it's not investing. By the way, I think those got shut down with the after the crash of 29.
The crash of 29, yeah.
Sort of finished
and my guess is that what is called a fully backed tokenized stock, that's where the custodian actually holds shares of stock backing up the token. Okay, that could be legit. Okay, but
I think that's what many people are thinking about.
But there are synthetic tokenized stocks, which are merely bucket shops where they're just you're betting on the value with another bettor.
And for those who are trading too many tokenized stocks, I think you could safely say they're one token over the line.
I'm going to get accused of not laughing
Next
again.
Question.
But I can't laugh at that one.
From. How about those hosts that laugh at their stupid jokes? Yeah. How about from North Liberty, Iowa? Anthony writes us, comment about withdrawals before 59.5 on December 3rd show. Forgot to mention rule of 55. I guess. By the way, this comes up.
We don't remember all of the rules.
I'll be the first to admit it. Yeah. By which you can draw penalty free from a 401k or 403b for employers separate from the year you turn 55. Okay,
right,
yes,
right,
that's
right,
true.
Right. In 401ks. And there's
the
also the substantially equal contributions are only up until you turn 59 and a half. Then you can go to whatever. Yeah. It's just there's so many.
There's a lot of rules, a lot of caveats, et cetera, et cetera. So please don't hold us to knowing don't hold us to when we answer something to say the entire answer.
Right, because
try to paint as complete a picture as we
sometimes the
can.
entire answer would take the whole show.
That's right. But here's the question from Anthony. Would love to hear your opinion on a change made recently to my employer's TIA 401A, 403B, and 457.
Yeah.
They remove previous target date options and they replace options, which is the default for all new employees, contains an annuity. About 89% of people nationally stay in by default. By the end of the glide path, the annuity represents 55% of the portfolio. Now, that's the part that surprised me.
Well,
because everything
that's
I
more
read
than
says
Vanguard's new one.
that's going to be 25%. That's
Right.
And generally, when you look at these things, it's about 25. So 55 is a lot. Do you think, the question, a fiduciary advisor would recommend that 89% of humans should have 55% annuity at retirement? I was appalled by the change. The annuity is variable, it says, which also surprised me. 1% minimum return rate, similar 3 to 4 to treasuries. In other words, should people have the majority of their money in an annuity at retirement?
Again, I go back to the discussion we've had about annuities over and over and over again. They make sense for some horribly risk-averse people who must have an income that they can count on for the rest of their life. Now, if that person is married, then they have to accept a lower income because you need the joint life option. But the reality is not everybody needs it, and you have to remember, this is the part of it that we seem to forget. There's no magic out there. TIA has to make money on this annuity, which means they have to make more money than they're paying you. Now, what that means to you is that if you invested it kind of the way TIA does, you would make that extra money or have the potential to make that extra money, but that comes with risk. Are you willing to take it?
I would add to that have more than half of your money in any annuity that way. The risk then becomes liquidity, because if you need that money and you can't get at it for something that comes up, you can't get there. That's why I'm not a fan of annuities, but if you had to have one, I think the 25% that Vanguard's talking about, that feels reasonable to me, because the rest of your money could still be accessed should you need it.
And it's all arbitrary, by the way, because
It's
no one
totally
knows
arbitrary.
what your life is going to look like.
Exactly.
So I think Vanguard is approaching it more conservatively, which makes sense because, they're an investment firm. TIA is approaching it a little more aggressively because, they're an insurance firm.
And we've talked about insurance firms
motives
on this program previously. All right, final question from New Orleans, Louisiana. From Barton. He writes, Dear Don and Tom, I hold Vanguard's BND fund in my portfolio. I believe that's the Vanguard Total Bond Fund, correct?
Yes, it is.
Exchange-traded fund version.
Yeah.
As such, I recently received an email from Vanguard announcing their new BNDP, the Vanguard Core Plus Bond Index ETF. As described, this provides broad exposure to taxable fixed income market, including U.S. government bonds, investment grade, high yield corporate, and emerging markets debt. Just like the BND fund, the new ETF is categorized as intermediate in term. What are your thoughts on this new Vanguard ETF as a possible core bond holding, offering wider exposure to additional exposure to the wider bond market? And thanks again for making available to everyone your helpful advice via the internet. Brand new fund. Get the trumpets out from Vanguard.
I'm going to... Jack Bogle has... If he could hear this, he would literally be tossing and turning and probably trying to scratch and claw his way out of his grave as a zombie to take down the current management at Vanguard Group. He would hate this stuff because it's all pure, unadulterated, pandering style gimmickry on the part of Vanguard and all these others. Vanguard they're not happy being the biggest. They want to be the coolest kids, apparently, now, or cooler than they used to be. I bet you they're allowing colored shirts on campus now instead of white. I'm
not just
you.
white anymore? What about black
that,
socks and black shoes? They moving on from that?
Yeah, brown shoes now.
Oh.
You can wear brown shoes. BND.
All kidding aside,
it's Vanguard's answer to PIMCO.
Yeah.
I mean, it really is. PIMCO
I think you're right.
Is gimmicky. Now they're gimmicky, too. They are stretching the category dramatically. They can now have, BND is U.S. investment grade bonds.
That's right.
Okay? BNDP can be U.S. investment-grade bonds, high-yield bonds, emerging markets bonds, and non-U.S. bonds of various kinds as long as they're denominated in dollars.
So adding junk and adding
emerging markets and
countries in emerging markets, right? I mean,
right.
could be.
So what have they done? Well, their goal, I believe, is to increase the yield. That's their goal. Will they do that? We don't know. It's brand new. But what they're doing it, again, at the expense of that thing we talk about all the time. If you want to make more money, what do you have to do, my friends? Take more risk.
You know, the other thing that could be, we may be overthinking this, it could just be letter envy. They want to have 4 letters instead of 3. Did you think about that? They could just like K, B,
they have,
and D,
okay, this
P,
is a
something.
podcast, not a radio show, right?
Oh, okay.
They have letter P envy?
Well, I'm glad you were the one who said that.
The plus. It's the plus. They have plus envy, I meant to say. Plus envy. Is that better or worse? Actually, I think plus envy may be a little worse.
I'm sure the
than
censors
letter
will
P.
be all over that, so don't worry about it.
There are no
So,
podcast censors.
Oh, okay. So you're all good. So
there are
anyway, that, you know.
I mean, we don't even know what the yield is yet.
Nope.
Honestly, we don't. Vanguard
It's brand
hasn't.
new. It's not even up at Morningstar last time I checked. So.
No, they're not telling you what the yield is. My guess is it'll be fractionally higher.
Yep.
It's going to be well diversified, but
And again, let's just.
why are they doing this? Vanguard,
all the
why?
things you just said. They got to be cute. They're trying to be more cutting edge, et cetera, where they've always been stayed conservative. But let's, before we finish, just for the fun of it, remember, why do you hold fixed income? Is it for the yield? Is it to get
No,
rich?
It's for the stability.
Thank you. So if your thought is, I just want to make sure I wake up tomorrow and my money's still there, and maybe I'm making a little bit of interest on it, then I don't know you need this fund. If you look at it and say, wait, my bonds aren't making near as much as my stocks, then you go right ahead.
Again, yeah, BNDP is not for talking real money listeners, because you guys are not, you should not be using bonds to increase your return. That's the stock side that does that. The bond side is supposed to increase your stability. Not 100% by any means. Even if you were 100% in bonds, you wouldn't have 100% stability. But it's higher. It has been historically a lot higher than stocks, the stability part, not the yield.
Yeah, and because we're in a new year, I'm really voting for more stability in 2026. I had enough fluctuation, enough volatility in 2025. Let's just level things out, make it nice and easy and smooth. What do you say?
Yeah, good luck with that. Dreamer.
New year, same great
You're
attitude
nothing
from
but
Don.
a dreamer.
That's it. That's all
And
I
now
got,
we've
man.
got to end this show. Oh, no.
Goodness. Oh, I'm really sorry
no.
to say. Yeah, okay.
Yes, we do.
Yeah.
All of America is saying, oh, no, don't end the show yet. It's been so much fun. I'm tapping on my hand with my
Yeah, you
my
are.
pencil.
And it's a new year, new beginning for many of you. So take advantage of the same old offer that we've always made, and that is looking at your stuff, making sure you're doing it right, talking to an advisor. We do all that stuff absolutely free. You don't have to become a client. So it's a pretty good deal. We're carrying that over, Don, from about 2000. So we're carrying it on over to a new year this year. So take advantage of
Not
that.
from two. Well, okay,
Well,
that was
going back to the Merriman days.
For our firm, though, it's been
for our firm,
been
that would be
15 years or
2009. So.
Yeah, 2010. I don't think we really had anybody we were doing free
We
consultations
had
for.
we had 5 clients in 2009.
Yeah, but we weren't doing the free meetings because we didn't even have the radio show in 2009.
No, we did not. But I'm going to say that because that's when the firm started. So
Okay.
I'm going to
You can
stick
do
with
that
it.
if you want.
All right.
Since you were the founder, fine,
Thank
be
you.
that
Well,
way.
no, we were the founders. We're the founders.
Okay.
You're Thomas Jefferson. I'm George Washington. So it's all good.
Oh, I'm the more erudite of the two.
Oh,
You're the
way
guy
more.
with the wooden teeth.
I chew carefully. So take advantage of all the stuff we can help you with. So please
All
do
right.
send the questions, ask an advisor, et cetera. So it's
At
all
talkingrealmoney.com. Is that
That's
the
it.
place to do
Yeah.
it? All right.
New
Well,
year,
then-
same great
then Go
website.
there. Thank you for listening. Thanks for being a part of our little podcast. Thanks for making us huge. By the way, I really can't tell you how much Tom and I appreciate you listening and telling people about the podcast, because we have really exploded in terms of popularity. We got like 2 million downloads last year, and whew, we really appreciate that. That's a big number. Thank you. Take care of yourselves. I'm Don. That's Tom. And both of us, almost every day, really enjoy talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.